The eurozone heaved a big sigh of relief last week when Spain completed a successful bond sale. Today it was Portugal's turn, and tomorrow Italy will tap the market for as much as €1.5 billion of debt. We're looking at the appetite for sovereign bonds this morning with David Keeble, head of interest rate strategy at Credit Agricole. He is with us from London. David, glad you could join us today. Let us talk about the appetite for European sovereign debt, given all the questions swirling around the $1 trillion bailout package, the future of deficits in Spain, in Italy, in Portugal. Why are people buying these bonds?
Well, there are two fears, of course. There's the liquidity fear and there's the solvency fear. And I think what we're learning at the moment is that liquidity issues aren't so pressing as we had imagined maybe 3 or 4 weeks ago, and that the countries can actually fund themselves fairly well at the auctions. I wouldn't say this is because there's an enormous amount of demand, but what we see happening is really that the illiquidity in the secondary markets is helping people, is pushing people towards the auctions. And additionally, we tend to find that the bonds being sold cheapen up so significantly in front of the auctions that they're simply not touched until auction day, and then everyone sort of grabs a piece of it. So it looks like we are getting through at least this liquidity bubble, and the redemption in Spain, of course, was a big focal point, but now that seems to be less threatening.
So, David, liquidity better than expected, but this still costs you if you're a sovereign borrower like Portugal, for example. I was just looking at the average yield on today's bond offering. So, Portugal sold more bonds than it had planned to sell, but at a yield of 4.7% almost, compared with a yield of some 3.7% back on May 26th. So it's expensive debt.
It's expensive when you look at it in spread terms. In actual yield levels, of course, Portugal, go back 3 or 4 years, we're paying well above this. It's not pleasant. There's no getting away from the fact that it doesn't help your debt dynamics in any way at all. If you could get away with selling something 100 basis points below here, that would be even better. But in the background, most of the fiscal numbers we're seeing coming through from Europe are actually coming in either at or above plan. And I think it's just taken a while for the market to appreciate this.
David, how much of a factor is the ECB here? To what degree is the central bank helping to support these bond prices?
I think there's spillover effects. I mean, we've soaked up a lot, or it's gone to the ECB, something in the region of 57 billion, and that's all the high-yield debt. And of course, it leaves the market just a little bit short. No one wants to actually sell these bonds. You really could be squeezed out for the ECB to come back in, but it has to be said that this week the ECB has been very sparse in its purchases, if at all. So this has enabled the spreads to start to widen out in the last 48 hours.
David, very briefly before we go, can we say at this point whether the eurozone is past the most dangerous phase when it comes to debt sales?
Probably. We tend to front load a lot of our issuance in Europe, and so if you look at everybody except maybe Italy and Germany, they're all about 60 or 70% done for the year. So second half it should ease off, particularly for the under pressure peripherals that clearly have seen their spreads widen more than we had hoped.
David, thank you very much. David Keeble, head of interest rate strategy at Credit Agricole, talking about European sovereign debt.